This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Well, back in chapter 22, we got introduced to the concept of groups within our area of study of corporate tax. There it was, we defined, for taxation purposes anyway, two types of group. They were 51% groups and 75% groups. Depending upon that share ownership that the parent company had within the subsidiary company, various things either had to be done or could be done. There were claims and elections. Clearly, claims and elections only being done if it was advantageous for the group of companies in its entirety. We saw there, for example, that in the particularly interesting area of 75% groups, we could have group relief of losses made by one group member, and we were able to group relieve any part of that loss against any part of another company's TTP, their taxable total profit there. We had flexibility. It was our choice. It was our decision. We could make that claim or not make that claim. There were also rules that applied. Again, in one of the more interesting 75% gains group areas there. And that was if you transferred an asset from one business to another, one group member to another, that 75% gains group member there, then you'd have a choice on how it would be done. It would be a no gain, no loss basis. And that meant it would transfer at the transferor's cost and then plus indexation allowance. So we had rules that said, if you choose to do this certain something in a group, you do it our way, the HMRC way. But if, say, losses are sustained by one of your group members, then you have the ability to choose to use that loss in any other suitable and defined effective 75% group member. You can claim as much or as little. There was flexibility. We, as we've said, only make claims or elections where they are beneficial. What we saw back in the area of 51% groups was one of those areas which was known as Group Vat Registration. We didn't deal with it then because we had to deal with it here in chapter 25 once you knew a little bit more about VAT. So what is this? Well, the concept is a pretty simple one. Group VAT registration. What we've seen so far in this particular chapter is that a business, now that could be an unincorporated trader or a company, of course, but a business there either could choose to register if it made taxable surprise, or had to register if it met the compulsory registration limits there. And once it was registered for VAT, then it would have to submit VAT returns accounting for the output VAT less any input VAT upon that VAT return. And normally it would work that way, that output VAT would exceed input VAT, and on that basis, therefore, the company, the business, would pay over to HMRC. Well, now, if you've got a group of companies, this group defined as being a 51% group, you don't have to have 75%. It's only a 51% shareholding that is required between the parent and the subsidiary company. Then those companies, if they choose, can enter into a group VAT registration. So, in essence, it's very simple. If they choose to do so, then only one VAT return will need to be submitted rather than each company submitting their own VAT returns. Let's look at some of these points now in the notes in front of you. We've got two or more companies indeed. Let's make sure the pen works. Two or more companies, there we go, can register as a group for VAT purposes. They must be under common control of a third company and resident in the UK. We must have a permanent, a fixed establishment in the UK to join in a group VAT registration. In relation to that, therefore, we could see that we might have this situation. Parent company A Limited, and unsurprisingly here for our examples, three shares, three companies in which we own shares, named V, F and C Limited there. But then we look at the shareholdings. A controls V Limited and also controls F Limited. It does not control C Limited there. Now, whether that control is 80%, as with V or 60% as with F does not matter for purposes of group VAT registration. So what you have here is excluding company C, because we don't have control, we only own 40%. We have A Limited controlling both V Limited and F Limited. And what that means is that all of those companies, or two of those, and any two of those companies, could enter into a group VAT registration. Now then, in relation to that, as we have seen, just because we have the parent company and the two subsidiary companies there eligible for the group VAT registration doesn't compel group VAT registration. And if you want group VAT registration, you can choose which companies enter into that group VAT registration. If you want just the two subsidiary companies and not the parent company, fine. If you want the parent and one or other of the two subsidiaries, fine. And we'll talk why it is that you might choose here to leave out one of the companies eligible for group VAT registration, why you might choose to leave it out of the group VAT registration. If we're going to choose to do something, got to be a reason for it, and we'll talk about that in a moment. So there, A, V and F are all entitled to enter into a group VAT registration. The A Limited Group will decide which of those companies, if any, to put into that group VAT registration. And then one VAT return will be submitted for those group VAT registration members. And that doesn't have to be the parent company. The group will nominate the so-called representative member, the company to represent the group or the members of the group within that group VAT registration with HMRC. So returning to our notes, therefore, two or more companies can indeed register as a group for VAT purposes. They must be under common control of a third company and resident in the UK. Now, that's what we've seen in terms of the usual group stuff we're dealing with companies. In point of fact, if you had a situation here where it wasn't A Limited, but it was an individual or even, say, a partnership, then although A, not again necessarily a trader registered for VAT, but V Limited and F Limited would be under common control of A, the individual, or A, the partnership, in which case V Limited and F Limited would still be eligible for a group VAT registration. They are under common control. Once we have defined who is eligible, and chosen which of those eligible companies, or companies indeed that we would like to be within the group VAT registration, then for those companies, the group is treated for VAT purposes as if it were a single company, registered VAT on its own. So what does that mean? It means, as we've said, only one VAT return is submitted for the group. That, therefore, presumably, is an administrative advantage. If we've got several members of a group, instead of each of those members doing each of their own individual returns, it could all be done in one VAT return. No VAT also will be accounted for on transactions between group members within the VAT group. An intra-group transaction is said to be outside the scope of VAT. Now remember again, it's important to define what we mean when there is no VAT that is charged upon a supply. Is it as it is here? It's outside the scope of VAT. Or is it zero rated? Or is it an exempt supply? This isn't a supply for VAT purposes. It is outside the scope. No VAT to charge on the sale. No VAT to look to recover on the purchase. Goods can be transferred without reference to the VAT system. As we've already said, the group can choose which companies to include or exclude. That's down to us to make that decision. In terms of who submits the group VAT return, the representative member of the group is appointed, and it's that company that is responsible for completing and submitting what is a single VAT return and paying the VAT on behalf of the group. That said, though it is the one that submits the VAT return and makes the payments, it is the case that all companies in the VAT group are jointly and severally liable for any VAT liabilities of the group. So the VAT could not build up a large amount of unpaid VAT in the representative member, such that it was then insolvent and liquidated, saying to HMRC, oh, sorry guys, this particular company, which just happens to be the representative member, hasn't got any income, hasn't got any money. It's therefore going to be liquidated. Sorry, bye. No, it ain't going to work. HMRC will say, no problem. All of your other companies within that group VAT registration, they're all jointly and severally liable. So if the representative member can't pay, then we'll go to other companies within that group. They are all liable there. Now, we said about we could choose whether or not to include or exclude the eligible companies, those within a 51% group membership there, those that are under common control, more than 50% shareholding. And we'd think that it would be a good thing to have them in there, getting those benefits of, so we don't now have to submit individual VAT returns. Intra-group transactions are outside the scope of VAT. Seems like a good idea. So why is it that we might choose deliberately to exclude one of the companies from that group VAT registration? Well, as it says here, it would be beneficial to exclude a company making zero-rated sales. Now remember, if a company makes zero-rated sales, that means it is making taxable supplies, but no VAT, no output VAT is chargeable. But if it is incurring standard rated costs and expenses, well, what that means is there is input VAT. So if for any VAT return period there is no output tax, but there is input VAT, what does it mean? It means, therefore, that HMRC pay you. You get money back from HMRC. And that begs the question of, well, how often would you like to get that back? And you'd like to get it back monthly rather than the usual quarterly. So on that basis, you may choose to submit monthly returns. Why would you choose to have that extra administration? Because you get cash coming into your bank account every month rather than waiting until the end of the quarter before you get that repayment from HMRC. So you may well consider, and certainly would if the numbers, the amount of repayment from HMRC was considerable for such a company, that if it made those zero-rated supplies but had standard-rated inputs, then let it continue on a monthly return basis so we get repayments from HMRC every month, while all the other companies in the group, or those that we choose to be in it, we will submit a group VAT return on a quarterly basis, so we'll pay them quarterly. Good idea. We get money from HMRC every month. We only pay amounts to HMRC every quarter. That's got a cash flow advantage. By the time we get to the end of the quarter, of course, then the same amount overall will have been net paid to HMRC. But in between times, we've got that money flowing in each month. That would seem to be a good idea. That's the point made here. We would then be able to continue making monthly returns to get the improved cash flow of monthly VAT repayments, therefore. It isn't all plain sailing. It isn't always one way of being, this is a good idea, let's do it. And therefore, there are some disadvantages of group VAT registration. They are that the limits for both cash and annual accounting schemes that we saw earlier will apply to the group as a whole and not on an individual company basis. As we've already said, joint and several liability of each company in the group will exist. So if the representative member can't pay, the other members of that group VAT registration are liable. And also that we've said administratively, there's now only one VAT return to submit rather than however many companies are in the group. You've still got to get all that information from each of those companies into the representative member so it can submit its own VAT return for all members of the group VAT registration. So possible admin issues collecting the information that is then to be passed on to the representative member. So there we go, an option available when dealing with, usually within a group as we would know it, where at the apex, the holding entity who owns the shares in those companies is indeed a parent company there. Well, the final issue that now we need to deal with here at the end of our VAT studies is this section 12, dealing with UK businesses now trading overseas. Now, that trading, of course, could be in either or both of two forms. That is, we could sell to overseas customers. So what happens in relation to the sales we made? Are they taxable? What do we do in relation to VAT on that sale? And then in relation to our purchases, we may buy in from overseas suppliers. What happens when those goods come into the UK? How do they get affected by the VAT system? Now, thankfully here, we have at least, one bit of good news that arose out of Brexit, if any good news did indeed arise. But here it is good for you, and that is that we've only got one system to know about rather than two. Prior to Finance Act of 2021, in terms of our syllabus, we just had we had two systems to deal with. One where we had transactions with other VAT registered businesses within the EU, and then when we had transactions with any other businesses outside of the EU. Now we're outside of the EU, so we have one system that applies to all of our sales and all of our imports, our purchases from overseas suppliers. So what have we got? It is, as I said, the cessation of the UK membership of the EU means that there's now no difference in the VAT treatment for transactions between the UK and the EU and between UK and the rest of the world. So we've got one system to apply in relation to our sales, i.e. the VAT treatment then on exports, what we sell to overseas customers. How do we deal with the VAT treatment on those sales to overseas customers? And then in relation to imports, what impact does that have on the VAT system when we're buying in from an overseas supplier? So those issues must be appreciated on these transactions, but for Tax UK purposes, only the following rules would be relevant. So we just need to know the basic rules. There are different exceptions, indeed, many of them, within the real life scenarios. So this is just the general overall system. And we've got to deal with two issues. First one, probably it is the most important, and that being the supply of goods. And secondly, then the supply of services. So let's look at the big one first, the supply of goods. In relation to our sales, then life is incredibly easy. On exports that we make to overseas customers, then the supply of those goods to all overseas countries for, again, VAT purposes is now zero rated. They are zero rated sales. So what does that mean? It means that in relation to the sale, it is a taxable supply that we are making. And that means that if we have had purchases or expenses incurred in relation to making that particular sale, because it is a taxable supply, whether standard rated or now zero rated as this is, as it's a taxable supply, then any input tax on purchases or expenses incurred in relation to the sale that we now make to that overseas customer, all of those input tax figures would be recoverable. So exports, very easy. Wherever the customer may be, whether it's inside the EU or outside the EU, makes no difference. Every sale made will be zero rated. It's a taxable supply, but with no VAT to account for. We then have to look at imports. So what happens when we buy in goods? And but this is where, as you can see, we've got rather a lengthier note here. So it can be a little bit more awkward. At the end of the day, these are rules, a system that you learn and you follow. And there's not that much to it. There's a bit more, obviously, than in terms of exports, but there's not that much. You do it. No one is going to ask you, well, why do we do that? But I always have an issue here in terms of trying to explain to students what this system is, because they're still trying to think, well, why do we do that? We like to be able to understand why. Now, like I told you in the very first lecture, let alone now the very final lecture in terms of our studies of Tax UK, that it's a learning system. There are a series of rules that are laid down, and you learn them, and you follow them. You may not like them, we may not always understand them, but we learn them and we follow them, and that means that we get our questions right. But what I'll do here, we'll find out in a moment whether this is a good thing or not, is try to explain to you why it is that the system we have here is the system that we operate. But again, if that poses a problem, don't worry, you simply need to learn the rules. What do you do when you import goods to the UK? All right, let's try the basic explanations. Now let's have a little look at, again in terms of buying goods here. If we buy goods costing £10,000 excluding VAT from a UK VAT registered trader, when we buy those goods in, assuming it was a taxable supply to us, then our purchase cost will be the £10,000 plus the VAT thereon, £12,000. We will pay our supplier in the UK £12,000, and the supplier must then account for the output VAT of £2,000. So HMRC will collect £2,000 of the £12,000 that we have paid to our UK supplier. They'll collect that from our supplier. It's the whole point of the VAT system, isn't it? Again, it's made in relation to a taxable supply, and that is not kept by the supplier. That is payable over to HMRC. Now then, we bought those goods in. It cost us £12,000. But if we make taxable supplies, so we take those goods in, we use those goods then in the making of a taxable supply, then the £2,000 input VAT that we have effectively suffered, we paid our supplier £12,000 instead of £10,000, then that £2,000 input VAT is recoverable, and it will be recovered there. So therefore our net cost is going to be £10,000. We paid £12,000 for the purchase to the UK supplier, and we've then been able to claim back the input VAT that we suffered on that purchase of £2,000. Our net cost is 10. But if we make exempt supplies, there of course was that critical issue. And we saw this back at the very beginning of our VAT studies when we differentiated between those supplies that were taxable and those that were exempt. If we were to make exempt supplies, then input VAT is irrecoverable. So we'd have paid £12,000 to the UK supplier, and we can't get anything back in the form of the input VAT that we've suffered on that purchase. So our net cost is £12,000. So a very different outcome depending on then the types of supply that we make. If we make taxable supplies, the £2,000 input VAT is recoverable. If we make exempt supplies, the £2,000 input VAT is not recoverable. Our net cost, either £10,000 if we can recover, £12,000 if we can't. Now let's talk what will happen if we purchase those goods from an overseas supplier, assuming that the net cost is again a cost of £10,000. That's what we pay to the overseas supplier. We make purchases from an overseas supplier at a cost of £10,000. So what do? We would pay £10,000 to the overseas supplier, and because it's come from overseas there would be no VAT on the purchase. Something that there would have been, oh hello, there we go, something going wrong with the pen, something which there would have been had we bought it from a UK supplier. So we've paid out £10,000 to the overseas supplier, job done. So our net cost, therefore, would be £10,000, irrespective of whether we make taxable or exempt supplies. Again, that wouldn't now be an issue, because we haven't suffered any input VAT within the VAT system. All we've done, we bought in these goods from overseas, that vendor has dealt with their own sales tax system or VAT system, whatever it might be, but we have paid the £10,000. Okay. If we did make exempt supplies, we would therefore save £2,000 by buying from the overseas supplier. If we were to buy from the UK supplier for £12,000 and we make exempt supplies, our net cost is £12,000. If we instead buy in from the overseas supplier for the actual purchase of those goods which have a value of £10,000, but we're not now suffering any VAT on that purchase, then we pay £10,000. What would then happen is, if we are onward selling in relation to those goods, whatever it was we bought, then in relation to that sale, if we make exempt supplies, then our net cost would still only be £10,000. If we bought from the UK supplier, our net cost would be £12,000, as we've just explained. So that would mean that we'd have a situation where our taxation system was actually encouraging you to buy from an overseas supplier. Well, that can't be a good thing, can it? So HMRC have to do something here. And what HMRC operate is what is known as the reverse charge system in relation to our imports. Now, the notes that we have, if we go back to that, then I'll come back to this example. On imports, we're buying in from overseas suppliers. We're going to have to account for input VAT on the VAT return that includes the date that the goods, which includes the VAT return, which includes the date that the goods are imported. So whenever the goods were imported on that VAT return, what do? We're going to have to account here for input VAT under what's called the so-called postponed accounting system. Now, it's not a name that you need to be familiar with, but that's the name of it, and I'll explain where the word postponed comes in just a while. But what it means is that import VAT is declared on this VAT return. So for the VAT return in which we have made the purchase of these goods from the overseas supplier on this VAT return, we have to then account on what is the purchase by us, the sale to us, but we have to account for output VAT. Yeah, what we actually have to account for on a sale. We have to account on the VAT return for output VAT. So that means the output VAT is going to go on to that VAT return. But that figure may then be reclaimed as input VAT on the same VAT return, so long as the business makes taxable supplies. So on the same VAT return, the VAT return for the period that includes the date when the goods were purchased from our overseas supplier, we are going to have, if we in turn go on to make taxable supplies, we're going to have output VAT of £2,000, if it's like on the £10,000 figure I said a moment ago, and I'll go back to that example in a second. We're going to have £2,000 of output VAT and the same £2,000 of input VAT. Hence, therefore, there will be no net cost to us. Again, just to show you what's going on here, on our import cost of £10,000, we account for output VAT of £2,000 on our VAT return. That's what that note said. For the VAT return in which the import is made, we must account for, no matter what else happens, output VAT on that import of £2,000. So in which case, the cost to us of that purchase has now become the same as it would have been if we bought it from the UK supplier, i.e. £12,000. The £10,000 that we paid to the overseas supplier for the sale made to us, plus the £2,000 we have to pay out to HMRC in relation to that import. If we then make we make taxable supplies, we will be able to reclaim the input VAT of £2,000 on the same VAT return. So we'll have output VAT of 2,000, input VAT of 2,000, therefore our net cost will be £10,000. If we had bought from the UK supplier, remember what would have happened. We'd have paid them £12,000 in relation to that purchase. The UK supplier would then have accounted for the £2,000 of output VAT within the UK system. We'd have paid £12,000, and on that purchase of £12,000, if we make taxable supplies, we would be able to record then the input VAT on that purchase of £2,000 and therefore have a net cost of £10,000. Now, with this system in relation to the overseas purchase, it's exactly the same. Our net cost is still £10,000. And if we were instead to make exempt supplies, then we cannot recover input VAT of £2,000. So now if we cannot recover that, our net cost is £12,000. I repeat, the £10,000 we paid to the overseas supplier and the £2,000 that now we pay to HMRC. So what you've now got is exactly the same outcome in terms of our net cost, irrespective of whether we buy in from overseas or whether we buy in from a UK supplier. If we didn't have this system, we would have just paid £10,000 to the overseas supplier, and then our net cost would be £10,000, end of story, irrespective of what we then went on to do with those goods, whether with them we made exempt or taxable supplies. That would have meant, well, if I make exempt supplies, then I'm going to buy in from the overseas supplier, because that will cost me £10,000, whereas it'll cost me effectively £12,000 if I buy in from the UK supplier. And that would be a very silly system indeed. Hence why we have this so-called reverse charge system. And this reverse charge, or self-supply as it may be known, procedure, means that for most businesses there is no VAT cost, because the output VAT that we are required to account for, the import VAT, the output tax going to our VAT return, because the output VAT and the corresponding input VAT are equal, so that no VAT payment is required. Again, it seems like a pointless exercise, but I hope you understand now why we do it, because if we made exempt supplies, if the UK business makes exempt supplies, it will not be able to recover the input VAT and hence will incur the VAT cost, meaning that with a like-for-like purchase of £10,000 from the UK supplier or the overseas supplier, now by having this system, if we make an onward sale in relation to a taxable supply, our net cost under either system is £10,000. And under this system, if we make an exempt supply, our net cost is £12,000. It is the same. Now, the example I've just done with you attempts to illustrate why it is that we have this system. And I've done that simply to try to avoid otherwise you reading through this and saying, well, that doesn't make any sense to me, and then sending me a little question on the Ask the Tutor forum. Instead, I hope you can do that. But at the end of the day, these are the rules. And all we've got to do is, on the VAT return, for the period, the VAT return period, in which we make the import, we have that purchase. What we will do is to always account for the output VAT in relation to that import. And then we will be able to reclaim the input VAT so long as what we do in terms of our sales that we in the UK make, as long as that's a taxable supply. And we end up that whether we make taxable or exempt supplies, our net cost will be the same. whether we bought in from another UK supplier or whether we bought in from overseas. So those are the rules to learn. And as we've just said, clearly when we go on to make a sale in relation to any goods that we bought in, when the UK business subsequently sells such goods, then the normal VAT rules will apply. Is it a taxable supply? Is it an exempt supply? Do we or don't we charge output VAT in relation to that? So in relation to that, we have example 8. And here in example 8, we have been asked to, we're asking you indeed, to discuss the VAT implications of the above transactions. And again, as often it is, but always read the question carefully. All transactions, the numbers you see, are stated exclusive of VAT. So we're dealing with BW Limited, a UK VAT registered UK business that makes only taxable supplies, no exempt supplies. It acquired £12,000 of goods from its suppliers in the United States of America and £20,000 of goods from its supplier in Germany. Last year, that would have mattered. This year, it doesn't matter because we've got one system. And that was made in the quarter to the 31st of March 2022. In the same VAT quarter, BW Limited made sales of £50,000 to a VAT registered customer in France and £10,000 of goods to a business in Australia. Again, last year, 2 separate systems you would have needed to have sorted out and to have explained. Now, it's very much easier, isn't it? Because as we know, in terms of exports, the sales that we make overseas, they're all 0 rated. But I'd like you now, given what I've just said, look back at the notes, think it through, to actually have a go at that in your own words, try to write out what is going to happen, and then look at the answer in the back, and I will quickly discuss that with you when you come back to me. What we'll then have to do is very quickly deal with the supply of services, where again, it's simply a rule that applies if we are making that supply of services to an overseas business customer, to an overseas customer there, or whether we are receiving a service from an overseas business. But more of that after you have a go, please, at example 8. So pause at this point. Okay, let's see what we've got. So easy marks to be had to begin with, and that is, of course, that the exports of goods to the VAT registered customer in France and the business in Australia, doesn't matter who is in the EU and who is not there, that will be 0 rated. All of our sales, all of our exports to overseas customers are going to be 0 rated. It's the import of goods that seem to be more awkward. Now again, if you just simply learn the basic rule, then it's a quick rule to learn and now to regurgitate. Because the import of goods from both the supplier in the USA and in Germany, again, it doesn't matter where they are sited, wherever in the world, it's the same system here in the UK, will involve a self-supply with output VAT of 20,000 plus 12,000 at 20%. So both of those sales at 20%, both of those purchases at 20%, £6,400 being accounted for by BW Limited on its VAT return for the quarter to 31st of March 22. So we are counting for output VAT there in relation to that so-called self-supply. As BW Limited makes wholly taxable supplies, then the same amount of 6,400 can be recovered as input VAT, and therefore no VAT cost will incur. Now, the vast majority of businesses are going to be making taxable supplies. Whether they are standard or 0 rated, it doesn't make any difference, they're making taxable supplies. In which case, therefore, the system that we operate, this reverse charge system, means that in VAT terms, there is nil net cost. We are required to account for output VAT on the so-called self-supply, hence the output VAT self-supply. We are making a supply to ourselves effectively there, but in relation to the import of those goods. And as long as we make taxable supplies, it is also input VAT the two numbers match, it's on the same VAT return, so there's no net cost. If we made then exempt supplies instead of taxable supplies, we still have the output VAT, that is a constant, but there'd be no input VAT that we would be allowed to recover. Just go back to our notes for one moment. I referred up here to the so-called postponed accounting system. Just in case, as you'll probably read that in texts if you have the other forms of study manuals there. All it means is that we are now able to postpone accounting for the import VAT, this self-supply. We're avoiding having to do that in relation to we only have to put that through for the VAT return period in which the purchase was made. What again preceded this before Finance Act 2021 was a requirement that when those goods were shipped to the UK, in order to get those goods at the port out of customs and take them to our place of business, we would there and then have had to pay over the VAT in relation to those goods and then seek to recover it in relation to our normal VAT return system. So there was actually a payment being made. That doesn't happen now. Hence, we're postponing in terms of accounting for the VAT. We're postponing that. We would otherwise have had to have paid it where we took the goods. We now simply have to record it in the VAT return in which those goods are imported, and by which time we've got them in, we then got the output VAT to account for, but now on that same VAT return, we can record the input VAT. We're not going to have to pay anything at all, unless we were to make exempt supplies. And finally, the supply of services. Basic rules in terms of whether we are supplying a service to an overseas business customer, in which case it's outside the scope of VAT. It is not an exempt supply, it is not a taxable supply, it is outside the scope of VAT. There is no VAT to account for. If we are receiving a service from an overseas business, then it's the same self-supply or reverse charge system that applies as for imports above. So when that service is supplied to us for the VAT return period in which the service is supplied, we have to account as the UK business for the output VAT in relation to that service cost. And as long as what we do is to then go on to make taxable supplies, then we can recover that output VAT as input VAT and it's cost us nothing. But again, if what we do is to make exempt supplies, we're going to suffer that output VAT cost. So it's all down to what types of supply do we then go on to make. Taxable, we recover it as input VAT. Exempt, we cannot recover it as input VAT. Okay, well that's it therefore in terms of chapter 25. And a big chapter it is too, but it's one chapter and it's going to be, most likely, one of the 10-mark questions in section B. So there is a lot to learn, and it's far more a learning than possibly a doing exercise there. But again, it is practice, practice, practice. As everything that we've done here in relation to all of the technical chapters, it's all about, yes, you must learn the rules, but then you have to apply them, and that requires practice. Practice that has firstly come from the examples and illustrations that we have within the lectures that we've seen, within the study notes, plus other class examples that I've made up in the lectures as we've gone through. You have those. You've then had the practice questions. You've had the examples and illustrations within the various technical articles that you've been referred to at the end of each of the chapters there. But what you also need, and we've said this before, is that you must acquire, if you haven't already done so, some sort of exam kit, whatever they may be called these days, but from one of the approved ACCA suppliers there, approved ACCA provider, because it is only with lots and lots of practice that this will become routine. Remember, at the end of the day, you are taking examination. You are not here being tested within the confines of a professional office where what you do has to be 100% correct. Otherwise, it's wrong. What you've got to do here is to satisfy the examiner. Now, that is still broken down into little chunks. In terms of any 2-mark objective testing question, that little bit you have to get right. You can't make a mistake on one part and then come up with the wrong designatory letter. But we are about passing the exam. You get 50 marks or more, you pass the exam. Hopefully, a lot more. But 50 at this point will do, you pass the exam. And then the UK taxation system need not ever bother you again as long as you live. Unless, of course, you choose to take the advanced taxation paper when you get through to the final stage. That brings this to an end. Therefore, I wish you well in terms of your future exams.